thank you all for joining us today. I guess first things first, a bit of an introduction for myself. I'm a financial markets professional, and I've been at Xe now for coming up to 9 years. And we work with businesses across all industries that conduct business on a global stage and have a foreign currency requirement. But more specialised, I head up a screen unit at Xe that we've been developing for, a good 6 or 7 years now. So I work with producers of all levels of experience across all formats and budget sizes. Over that time, we've developed quite a bespoke offering here at Xe for screen clients when it comes to transacting and hedging their currency. But personally, I've just recently made the move across to New Zealand from Sydney, and work with a lot of Australian producers and work with the odd Kiwi producer project here and there. So very much keen to support the industry more over here and work with more Kiwi producers. But the topic of today's workshop, we're going to be talking through all things foreign exchange. We're going to be talking about the production budget, exchange rate fluctuations, and how to basically mitigate that and manage your currency risk through the process of hedging. And I'm going to run through 4 practical tips that are going to help with that and simplify the whole process and maybe demystify a few myths. And also as well, we're at a sort of interesting inflection point in currency markets and more broadly the global economy. So I'm just going to provide a little bit of practical colour on that and the state of play with the Kiwi dollar and what to expect in the short and medium term as we head through the rest of the year, and what that means if you've got a project with a portion of your production budget in foreign exchange. We've got an hour and a half allotted for this session and plenty of time to chime in with questions. So like I said, I work with producers of all levels of experience. So if this is all totally new to you and you've got a very basic, or you think it might be a very basic question, don't hesitate to ask it. All questions are good questions. And obviously, likewise, if you're more experienced, please don't hesitate to ask questions. And feel free to stop either Rich or myself at any time through the presentation. Just a little bit of housekeeping just to start with, because I'm going to be talking about the currency markets. I'm going to be talking about product and using what's called a forward exchange contract to hedge and lock in cash flows. This is a derivative financial instrument. So just a risk warning, derivatives aren't suitable for everyone. What we're going to be running through today is not personal advice. So certainly after the workshop, if you're wanting to reach out and obtain some advice around a particular project that you have and your own personal needs, by all means, we can give you personal advice. But for the purposes of this workshop, it's not. Don't take it as personal advice. All right, so let's get stuck in. As I said, I'm going to run through 4 practical tips. A common response that I get, or some common responses that I get from producers when we start the discussion around managing their foreign currency requirements and protecting their production budget, and what they've done in the past and what their experiences are. A common response is that it causes a lot of frustration, or it's all too hard and confusing, or we cross our fingers and hope for the best. You win some, you lose some. Those kind of comments, and it doesn't need to be like this. I think there's some misconceptions around how difficult and confusing the currency markets are, and hedging, actively managing your currency risk is. So as I said, it doesn't need to be like this, and it's an important part of how you manage a project, because as you know, you've got a lot of different moving parts, and variables and contingencies when it comes to actually delivering a project. And by working through these tips and taking some key learnings away, you can remove one of those variables, that is exchange rate volatility, and remove that uncertainty and give yourself very much needed peace of mind. So let's get stuck in. The first tip is be aware of the impact that exchange rate fluctuations can have on your production budget. Now we're going to start off with something pretty basic here, some fundamentals, and that is, the direction of the currency and what that means for your project and your budget. Kiwi dollar climbing, which is what we're seeing at the moment. You can see the currency chart there, taking up most of the left-hand side of the page. You can see from our COVID lows late March last year, Kiwi against the US dollar, when fear and mayhem was really gripping financial markets, we're down at 54.69. And from that time on, we've seen this pretty startling rally in the Kiwi, and we're in a situation where the Kiwi dollar has been relentlessly climbing for pretty much all of that period. That's not great if we're got a portion of our production budget in US dollars and we've got incoming US dollars that we could need to convert to Kiwi dollars. The reason is that we receive less in Kiwi dollar terms when we're doing that conversion. So just a bit of some basics there to start with. Of course, on the flip side, Kiwi dollar falling, and that's largely what we've seen for the 2 or 3 years or more preceding COVID, was that we had a Kiwi dollar that most of the time was working in our favour. Sure, we had periods of, I guess, counter trend to that and the Kiwi dollar climbing, but during those few years, the Kiwi dollar was our friend and heading south. Of course, on the flip side, if we're shooting a project where we've got outbound foreign currency requirements and we're shooting offshore or we're paying a lead actor in US dollars, for example's sake, then the reverse obviously occurs, and a rising Kiwi dollar is good for that. Likewise, a falling Kiwi dollar is not. So it's important as well to be aware of just how quickly the currency markets can move, and I guess the size of a move and what that can mean for your production budget. Because if the currency is moving against us and we're not hedged, then that can start to punch some pretty serious and sizable holes in our production budget. I've used a bit of a theoretical example here on the chart, as you can see, of 500,000 US inbound production funding that we're going to convert to Kiwi dollars, and various points there as to what the outcome was when we did a conversion. Down at our COVID lows, 500,000 US dollars converts to just above 914,000 Kiwi. If we kind of fast forward through to the February highs that we saw earlier this year, above 74.5 US cents, well, 500,000 US dollars equates to 669,000 or 670,000 Kiwi dollars. So you can see there that we've got a variance of about $230,000 or 40% or so from our lows to the highs there. You can also see, post the US presidential election, I think it was about the 8th of November from memory, you can see the Kiwis really picked up momentum from that point onwards. And even more recently, just on the right-hand side, just to illustrate how quickly the currency can move. March the 23rd, the Kiwi government came out and announced their housing policy measures. And you can see we've had a pretty steep decline there throughout March, back below 70 US cents. 500,000 US dollars converts to about 720,000 Kiwi in late March. And then we've had a subsequent rebound in the Kiwi or a softening in the US dollar. And over a 3-week period there, most recently, the Kiwis heading back up, and today we're sort of back through 72 US cents. So again, looking at our conversion there, 500,000 US into 696,000 Kiwi. So over a 3-week period there, we're looking at a difference or a shortfall of around about 25,000 Kiwi dollars. So Richard, thanks for joining us. As making the point that it's important to be aware of how quickly and the extent to which a currency can move over a given period of time, and the potential holes that can punch in a production budget.
Yeah, ironically, the reason I was late, I was dealing with production that is dealing with a massive currency loss, which you're aware of. So yeah, I can talk firsthand how currency can have a massive impact. I think the thing that you don't realize is, even very small incremental moves on an exchange rate, which may only be a few points, can have tens of thousands of dollars of impact. Even just going from a 0.7 to a 0.71, can move. When you're bringing in money, can have a massive impact.
Yeah, exactly right. And like I've touched on, we're in an environment at the moment where the Kiwi is very much a strong outperformer, and is likely to be well positioned to continue that strong performance through the rest of the year. Just, I guess, touching on quickly on the state of play with the Kiwi dollar and what to expect. As we were coming into the start of this year with that significant step up from the US election onwards, a lot of your economists and your banks were calling the Kiwi well beyond 75 US cents through 2021. And surprisingly, after we saw those late February highs around about 74.50, 74.60 US cents, surprisingly, we saw some US dollar strength come into the market. And you can see there right on the right-hand side of the chart where the Kiwi dollar's tailed back off and fallen below 70 US cents. The main drivers there were, you've probably seen the headlines around bond yields in the US, and without getting too technical, effectively we're talking about the cost of borrowing money here, and bond yields have been spiking very aggressively over the last month or so, 4 to 6 weeks. And when that happens, it's hugely supportive of a currency, and therefore you've had the US dollar reverse course and strengthen over that period of time. And you've also seen some really strong economic data come out of the US. And despite the fact that their lockdowns were far more extensive than what we've done here in New Zealand, there's a lot of good news flow coming out around the US economy coming back to life, and the economic growth story there and the projections. And that's why we've seen the Kiwi sort of top out, plateau, and then head back down to 69 US cents. But we've seen some really interesting price action over the last couple of weeks, which suggests that the Kiwi is poised to, and already has started to resume its path back to yearly highs, and probably going to set itself up to push through 75 US cents in the next couple of months ahead. The reason why that is that here at home, the currency is supported due to our outperformance with managing COVID, not shutting down the economy to the same extent. Commodity-linked currencies like the Kiwi, the Aussie dollar, and the Canadian dollar are doing quite well in this environment as the global economy comes back to life and has demand for those commodities. So expect the Kiwi to continue to head higher. Expect volatility. We're still dealing with COVID. We're still dealing with question marks over the effectiveness of vaccine rollouts and COVID variants. So we're going to see headlines that really push and pull the currency in different directions. And whilst I'm saying that the trend might broadly be upwards, you're going to see some pretty significant moves in either direction in the short to medium term. So that's my thoughts on where the Kiwi is heading. Any questions?
Just picking up on that one. Obviously, you've been focusing on the US dollar there. I think there's a danger when you're looking at currency as obviously the US dollar is the benchmark, but the New Zealand dollar reacts differently to different currencies, and probably the sort of the three main currencies New Zealand producers are going to be dealing with are US pounds and the euro. Is there similar sort of trends happening with those as well? Sorry, put you on the spot.
Yeah, no, that's all right. That's all right. I think with what we've seen recently with the British pound is that it's been leading the way with its vaccine rollout program. So again, you've seen some positive headlines around that. The data flow, so economic growth data, consumer spending data, has been solid out of the UK, and of course they're working through the lifting of restrictions at the moment. So that has the outperformance that we've seen with the Kiwi versus the US dollar during the first quarter of this year. We haven't seen that to the same extent against the British pound. But what we are seeing now is that a lot of that good news story around the effectiveness with vaccines and solid economic data is kind of already baked into the currency pairs. You know, the markets are taking that on board. They've priced it in. So I think once the markets kind of get past that, and it's a similar story against the euro as well, then we're going to likely see an upside bias for the Kiwi against both the euro and the British pound as well. The euro's been out of favour until sort of the last couple of weeks because its vaccine rollout program has been very ordinary relative to the US and the UK. So the euro's been under quite a bit of pressure through January, February, March. Starting to right the ship there a little bit. So we've seen a bit of euro strength over the last couple of weeks. But more broadly, and just to put it in simple terms, expect an upside bias for Kiwi versus euro and sterling as well. Alrighty. Before I move on to the next tip, any questions there or comments at all from our attendees? No, okay, let's move on. All right, the second tip. Set an achievable budgeted rate of exchange in the finance plan. I can't stress enough how important this is. It's as far as compiling your finance plan and your production funding, and I guess a critical first step, particularly when it comes to managing the foreign currency component of your production funding. You know, this is an extremely important first step. And it's often where I see producers slip up when they're setting their budgeted rate. So what are we doing here? We're setting a theoretical rate within our finance plan that says when I'm converting my US dollars or sterling or euro, whatever the currency may be, into Kiwi dollars, this is the amount of Kiwi that I have after I convert that I can allocate to producing my project. If you get that wrong, or if you don't set an accurate budgeted rate, or if you don't then protect that rate, then this is when you start to see some pretty wide gaps appear in your production budget. So there's quite a defined and calculated process that you should run through. And like I said, it's often where producers slip up of all levels of experience, where there's not much thought put into the rate, the budgeted rate, and it might just be we're sitting down for a planning session. Okay, we need to talk about FX. We have a look at where the rate is on that particular day in that session, and we'll use that to set a budgeted rate of exchange. Or we might use a round number and just set that as a budgeted rate of exchange. Or in some cases, you know, you're putting together how much funding you've got to work with, and you pull out a number, a budgeted rate of exchange that gives you the total number or helps contribute towards the total number of funding that you've got, without sort of taking into account some key considerations. So I'm going to run through some three considerations here within this tip that you should look at. But before I do, Richard, your sort of thoughts on the importance of this?
Yeah, I mean, it's super important, but it's also really challenging. I mean, you know, as you've just highlighted, particularly when the currency is so volatile. I mean, the thing I would certainly recommend is being conservative, which is really hard from a financing perspective, because obviously the more conservative you are, the higher amount of money that you have to raise. But yeah, you're obviously going to be in a much stronger position ultimately, you know, if you have a currency gain than a loss, because yeah, if you're working to an unrealistic rate, you just, you know, you're in enormous difficulty, because you're then either in production or entering into production, and you've got a budget shortfall, and you're unlikely to get an increase from your financiers. Where obviously if you're the other way and you've been conservative, you're in a much better position, and it gives you greater flexibility. I guess the question which you'll touch on is, you know, as a producer, you're obviously not a currency market expert. Where do you turn to get advice, particularly in a volatile market, and particularly when you don't necessarily have a defined time frame. You're trying to finance your film or TV series at the moment, and you don't know whether it's going to happen in 6 months or a year or whenever. How do you set a realistic rate?
Okay, well, that's a perfect lead into to the three considerations that you need to be aware of when setting your budgeted rate of exchange. First things first, the length of time from now, that is when we're setting the rate, the budgeted rate in our finance plan, to when the actual cash flows are going to occur, and when you execute the foreign exchange. Also sort of taking into account when contracting close occurs, and I'll go into why that's important in a couple of tips. But obviously, the longer the length of time, the more exposed that you are to exchange rate volatility, and the more likelihood that the exchange rate will be further away from where you set your budgeted rate. So, broadly, the Kiwi over recent years has had an average range of around about 16-17% over the last 5 to 10 years or so. We saw that blow out significantly last year. Quite an outlier. A range of about 32%, I think it was, off the top of my head. But as I said, we're likely to see some heightened volatility continue through the course of this year. So, working off the average 17-18%, it can be higher, it can be lower. If you're a couple of weeks away from your cash flows actually occurring, then you can kind of say with some sort of confidence that the market's not going to move more than a 2 or 3% or so. It can, but most occasions it doesn't. But if you're a good 6 months away, or if Richard touched on there that the timeline is unknown, then you've really got to allow for that and a bit of a cushion for when you're setting that budgeted rate of exchange. The second consideration is what's actually going on with the currency pair. What's the state of play? Is it a significant uptrend or downtrend? Is it just kind of bouncing around in a range and it's a low volatility environment? What's the sentiment? Is it stable or is it shifting? All those sort of considerations. And unless you've got some experience in financial markets, or you're interested, or you've got a passion for the financial markets, and typically you're going to not have those answers or those insights or that information at the tip of your fingers. So, engaging with a currency specialist to get that picture and that commentary, and to help you set that budgeted rate, I think is an important part of the process. And we've touched on tip one, what's going on with the Kiwi and where it might head, and how volatile it's been. So they're all considerations that you need to take into account. And then adjust and reset if required. If timelines change, if the rate changes significantly, it's important to adjust and reset that budgeted rate. So again, you're providing some accuracy and some validity with your production budget. So I guess using a bit of a practical example, where we are at the moment, as I said, Kiwi US is nudging back up through 72 US cents today. If I'm closing and I'm due to start production within somewhere between 3 to 6 months, there's upside bias with the Kiwi, as I've mentioned. There's heightened volatility. We don't want to set our budgeted rate at 72 US cents because that's where it's trading today. That doesn't allow for those factors, those considerations, those current trends that we take into account. 3 to 6 months, I'd want to be setting a budgeted rate that's at least at 3 to 4% away from current levels. If I take into account the 25th March high at 74.64, again, we look at key levels in the market as well, because that's a factor. So putting all that together, I'd want to be setting a budgeted rate somewhere around 74.5 to 75 US cents. Personally, I'd be comfortable setting it a little bit higher than that, but that's really a starting point as far as putting an achievable budgeted rate of exchange. So as you can see there, we're allowing for a good a good 2.5, 3 cents, and really should be more than that to set a budgeted rate. Does that kind of sound like a similar sort of process that you go through, Richard?
Yep. And sort of picking up on that, sorry, which is an obvious point, but not directly related to you setting the rate, is once you are contracting with your financiers, they will always expect the producer to carry the risk on the foreign exchange. So the onus is absolutely on you to have a risk mitigation process. The other thing in that is it's normally in contracts. It doesn't specify what happened to currency gains, and certainly if, as a producer, if you see slipping into contracts that the financiers would benefit from the currency gains, I'd certainly be striking that out, because they can't expect you to be carrying the risk but not benefiting from the upside as well. So it's just something to keep in mind when you're contracting, is that you're always going to be on the hook for it. And depending on the financier, they may require you to lock in exchange rates and have forward contracts to ensure that there is no risk and there's a defined amount. But if there is any potential risk, it will always sit on the producer's side.
Yeah, some good points there. One more final point I'll make with regards to this tip and setting your budgeted rate of exchange. A producer will often ask me the question when we first start talking about a particular project, and it might be a little bit too early in the piece, it might be still at the development stage. When should we circle back and start talking about FX and putting a plan in place? And my response there is the budgeted rate. As soon as you're at a point where your various funding channels are starting to come together, and the composition of the production budget is starting to be a bit more concrete, then that's when we should have a conversation around setting that budgeted rate, and we provide you with a lot of information to do so, rather than just sort of, as I said, plucking a number out of the air sometimes, which is the approach. Okay, so that's the critical first step. Moving on to our third tip. Plan and stick to a process, and protect the production budget by hedging with FECs or forward exchange contracts. I talked to, again, speaking to a lot of producers, all levels of experience, and when you start to talk about hedging and managing your currency risk and using forward exchange contracts, sometimes the eyes glaze over, and it seems all a little bit too hard, too difficult. It's not accessible. Well, we're going to run through some information here that kind of demystifies some of that, makes it nice and simple and straightforward. And importantly, when we get into the fourth tip, sort of walk through how it can be more accessible if you've tried to hedge in the past but you haven't been able to do so because of the requirements there to provide some security. So first things first, protecting your production budget. Forward exchange contracts, I'm sure there's some of you here that are familiar with those and may have used those in the past, and others that not so much, and this is all new ground to you. But a forward exchange contract is it's a simple and most commonly used hedging instrument, which enables you to lock in a rate of exchange for a future transaction date. So they're used by trading businesses, importers, exporters. It's often the starting point to hedging, and then depending what your underlying needs are and your level of comfort and sophistication, then you can add some other hedging products to complement your forward exchange contracts. But the two key benefits are protection. So you're locked in a rate of exchange for a future value date, and that means that you need not worry about the currency moving against you. So Kiwi US production funding coming in, as we touched on in the first tip, we'd be worried about the Kiwi dollar heading north, so that when we're converting our US dollar drawdowns into Kiwi, we're going to be receiving less in Kiwi dollar terms. We don't have to worry about that with a forward exchange contract in place. We're 100% protected regardless of how far the Kiwi moves. So I often get asked a question, how much protection does it give you if the currency moves beyond 5 cents, 10, 15 cents, so you're still protected as the forward still do its job. It most certainly does. You're 100% protected no matter what the underlying currency is doing. And certainty. So again, this sort of ties back to setting our budgeted rate of exchange and providing certainty and known outcomes when we are converting our currency. So we'll lock in a forward exchange contract to correspond with each of your expected cash flows, your funding drawdowns through your project. So therefore, now today, when you've locked in the rates through the forwards, you know the rate that you're going to be achieving in 2 weeks' time, 2 months' time, 6 months' time, whatever the time period may be. So you're just removing any uncertainty whatsoever, and like I touched on, giving yourself peace of mind. Richard, any sort of comments there on?
Yeah, just a question on that one. Obviously, the nature of a forward contract is you're booking a future date at which you're going to convert money from one currency to the other, and it's for a specific date. If, for example, your financier is slow in paying an invoice and you don't receive the money on that date, is there some flexibility on that, even though they're fixed date contracts?
That's a very good question, and I guess the starting point with that answer is it depends who your counterparty is. Production cycles are uncertain, as you've touched on there. Cash flows inevitably or rather are delayed rather than brought forward. And we've certainly seen that throughout 2020 with COVID, causing significant delays. In some cases, your counterparty, whether it's a bank or a currency specialist, you've set your value date for the forward exchange contract. That is the date that the cash flow is expected to occur, and you settle against the contract. In some cases, the provider, the issuers of the forward exchange contract, they won't let you do what we call a rollover. So you push or amend the value date further back into to when you think that cash flow will occur. So that's something to be wary of. So they may make you close out the forward exchange contract, which then depends based on where the spot rate of the currency is trading when you do a closeout. Depends on whether you make a currency loss or a currency gain. So you could be liable for a currency loss if you're closing out a forward. So that's very important to be aware of. At Xe, we know screen production. We go through quite a defined process to look at settlement risk and who the counterparties are involved with the project and the production team and various other factors. And that allows us to apply quite a bit of flexibility when it comes to hedging and using forward exchange contracts. So we will roll over a contract if there's delays and give the flexibility to do so. So that's something to be very across. I mean, one recent example was across the ditch with Screen Australia that got experienced a lot of bottlenecks with processing their offset payments, some of which we were hedging because they were cash flowed in FX. And we're talking about 6-month delays here, and we were comfortable to roll those contracts because we knew the project, and in this case, we were waiting for a cash flow to occur through the Australian federal government. But the point there is that Xe can provide you with flexibility because inevitably cash flow dates will change. So I guess the question is forward exchange contracts. They are simple and straightforward. There's two clear benefits there. One of the downsides of an FEC, a forward exchange contract, is that you're obligated to deal at the forward rate, the rate that you lock in. So if you lock in a rate at 72 against the US dollar and the Kiwi moves in your favor and then it's sitting down at 69 US cents, you are obligated to deal at the forward rate. So that's something to be mindful of as well. But really what we're trying to achieve here is protection and certainty and peace of mind, rather than punting with the currency and trying to squeeze out some currency gains. So that's an important thing to be across. But given those benefits, why do a lot of producers not hedge shouldn't it be common practice for all, given the benefits? So I'm going to touch on why that is the case, and how you can overcome it.
Before you touch on that, Stuart, I think a point worth picking up on is when a producer's finalising their cash flow and the drawdowns for their financiers, that will determine obviously when you're booking your forward currency contract. So you need to be very mindful of that and preparing that cash flow to make sure it's as accurate as possible. And something I've been caught out on the past is there's a contractual date in a contract where a financier is due to pay that money. Inevitably, it's never paid on that day, and you have to take into account the fact that it's coming from Europe or the US, so there's normally at least a delay in that, and often there can be bank delays. So it's always wise to allow a bit of a buffer, and probably essentially, whilst your drawdown date may be the 1st of May, you probably should book your contract for the 7th of May just to allow a little bit of flexibility there. So, there's a bit of a safety margin, because transferring money between countries always takes a little bit longer, and depending on the bank, sometimes it can get held up.
Yeah, that's a very good point. When we're looking at a project and a series of cash flows or drawdowns, and the producers making comments around uncertainty and that type of thing, at the back end of those that drawdown schedule, so say for example where somewhere in the region of 6 to 12 months out, we'll often advise a producer to say, hey, if you're expecting the cash flow to occur on at the end of November, let's just push the value date of the forward out a month. It's a lot for a provider that doesn't have the same degree of flexibility that an Xe does. They have a lot more appetite to pre-deliver and bring a value date forward versus pushing it out and doing a rollover. And that sort of comes down to settlement risk and, question marks over whether a cash flow is going to occur or not. So thanks for raising that one, Richard.
Yeah, and Stuart, just the obvious dumb question in terms of the practical way in which it happens. Normally a financier would pay direct into the production account. When you've got a forward currency contract, they instead pay the money to you. You then convert it and pay it on. So.
Yeah, there's a couple of paths there. If the production holds a US dollar or euro or sterling denominated account with their bank, then yes, the funding counterparty will pay direct into that. The funds will then be transferred through to Xe. The settlement occurs against the forward contract, and then we'll pay Kiwi dollars, transfer Kiwi dollars through to your local production account. Not all producers will run foreign currency accounts with their banks. No problems at all. You have the funding counterparty transfer the funds directly through to a trust account, segregated trust account that Xe holds, draw down it or settle against the FEC, and then we transfer the Kiwi dollars through to your local account. You just want to avoid at all costs, and it does happen. You don't want foreign currency being transferred directly into your Kiwi dollar account that you hold with your bank. The bank may notify you and ask if you want to convert it or not, but in most cases they probably won't, and they'll just convert it at a retail rate of exchange, giving you a very poor rate of exchange, and you receive significantly less Kiwi dollars when that occurs. So by all means, avoid a scenario where foreign currency is being paid directly into your Kiwi dollar bank account.
Yeah, I can vouch for that. Just on that point, from a practical experience perspective, from my experience, the foreign currency accounts that are held in New Zealand, depending which bank you are with, can be quite clunky. With some banks, they actually don't hold them. They're held by an intermediary bank like Citibank or somewhere in the US. So in my experience with those those New Zealand-based foreign currency accounts, there can often be some significant delays. I've experienced money taking a week to clear into the account, for example. So if it's important that you get money as quickly as possible, which inevitably is in a production, it certainly is more efficient for the financier to pay the money direct into your provider's trust account. But there may be some instances where for various reasons, financiers are not comfortable to do that, but it's best to work, it's best to work that out in your contracting stage, so you're very clear on the process and you can time your cash flows accordingly.
Yeah, that's a good point there. Yeah, I'd say in my experience, it does arise every now and then. Thinking of some recent examples with not so much financiers, but with some of the US networks, so Discovery Channel and Nat Geo. Initially, they were a little bit reluctant to transfer production funding through to a third party. But then once we sort of walked them through who we are and our connection to screen and why this is the preferred path for the production team, they're more than happy to transfer to a third party, obviously a credible third party. Okay, so tip number 4, execute your foreign currency requirements via a counterparty with industry experience. This is really important, and we touched on some of, we asked the question on the previous tip, why is hedging and using FECs not commonplace for a lot of producers? And this here sort of speaks to why that is. And, you utilize the services of industry specialists across your legal needs, production accounting, tax agents, financiers, so on and so forth. So it stands to reason that, if you want to achieve the best outcomes when it comes to transacting your currency, hedging, particularly for those that are more at the inexperienced end of the spectrum, someone that's going to hold your hand through the process and educate you and make sure that you're comfortable with everything that you need to know around managing the international component or FX component of a project. This is why you should be dealing with an industry specialist. Why do many producers not hedge? For me, in my experience, this typically comes down to 2 factors. Talking about the more inexperienced end of the spectrum, but to be honest, for all levels of experience, very often it comes down to awareness. I'm just not aware of how you go about doing this. I haven't been educated. I haven't had the information put in front of me around basically what we've been talking through today. And also time. I think sometimes there's a perception that there is so much going on with my project. There's so many balls in the air. There's so many different variables and contingencies that I need to be across. And to be honest, I don't know the first thing about FX and the currency markets and hedging. So really, I've got to prioritize, and I can't devote any time to that. So that's sort of the first the first reason. And like I've said here, forward exchange contracts, they are a pretty simple product. They're very commonly used by trading businesses, but less so by producers because of what I've touched on here. The second reason, when a counterparty issues a forward exchange contract, so whether that's a bank or a currency specialist, similarities to a line of credit, it exposes the issuer to settlement risk. That is, we're establishing currency positions for you at a point or multiple points in the future. There's an underlying cash flow that needs to occur at that point or multiple points in the future. And if that cash flow doesn't occur and you, the holder of the FECs, doesn't meet your obligations and settle against that forward exchange contract, then that leads to a settlement risk. And like I touched on earlier, depending on, you'd have to close out the contract or contracts, and depending on where the spot rate is on the day when you do that closeout, there'll either be a currency gain or a currency loss. Now, typically what an issuer of an FEC or forward exchange contract does, they work through quite a defined process to determine how high or low settlement risk is, to determine the probability of those cash flows occurring, and they'll conduct some financial statement analysis, and then that determines whereabouts you sit on sort of the risk profile. And then the issuer will request security, that is funds to hold on account, to manage settlement risk on their end. And that security comes in two forms. It's an initial margin or a deposit up front. So using our example on the first tip, when we were talking about converting 500,000 US into Kiwi, you take out a forward exchange contract in 6 months' time to do that. Your bank might say to you, okay, screen production, high risk pursuit, you haven't provided me with financials because you've set up an SPV to manage the project, so there's no trading history there. We need a 10% or 20% deposit up front to enable you to enter into that forward exchange contract. So 10% of 500,000 US dollars is roughly 70 odd thousand Kiwi. Well, in most cases, you're not going to have that cash flow, that liquidity, just to park 70 odd thousand Kiwi off to the side when you're trying to produce your project. So that's initial margin. It's a security product, security deposit. And then also they might request further funds to hold on account, further security. If the open contracts, they go through a process where they value the contracts based on where the currency is in real time. And if the contracts are out of the money, significantly so, then they'll ask for more security, more funds to hold off to the side. And that's very often prohibitive for a production team because cash flows are tight. We just don't have the liquidity to be funneling funds off to the side for the security requirements for forward exchange contracts. So yeah, they're the two main reasons that I see that often prohibit, say, a production team from hedging and using forward exchange contracts. Have you, I presume, Richard, sort of in your earlier years, you probably experienced the first one there around awareness and not being familiar with FECs?
Yeah, I mean, my first exposure to foreign exchange was on, of all films, River Queen, which is probably not the best example, but yeah, and those initial, that was 17 years ago, and I think we were paying sort of 5% margins, deposits, initial margins. So that was just manageable. But then not long after that, GFC kicked in, and I remember at one point, it was up to 40% margin, so it just became unaffordable for a short period of time. And thankfully now it's pulled back. But I think what's interesting in terms of when I originally got exposed to Forex, it was more complicated because of the margins, and there wasn't screen specialists per se. Where now it seems it's been demystified a lot, and it's a much simpler process, and it's not, and it's actually a lot more accessible, and I think it's much more commonplace than we realize. For example, as you guys know, in New Zealand has constant hedging contracts for buying fuel, for example. So most businesses who are involved in the export or import business, which we are regularly using contracts. So it's widely used, and as a result, I think it's becoming a much more accessible product.
Yeah. I'll just touch on my experience. I've had a couple of stints at the banks, and my most recent stint with the bank was sort of running through screen production and hedging, and how to take an alternative path to assessing settlement risk, rather than having a look at P&L balance sheet and cash flow. And in a lot of cases, the banks just don't. They're quite rigid as far as how they assess credit risk and settlement risk. And it all comes down to the financial statements. And you're typically establishing a new entity, an SPV, to manage your project with no trading history. So straight away, you're facing a challenge there where you don't have financials that you can rely on to get a hedging limit in place. What we do at Xe is we take quite a different approach. And that approach is to, well, first of all, you call on the experience of how is a screen project, put together? What are the key stages that it goes to get funded, to produce the project and deliver it? And that's not something that happens, in a matter of weeks. It's a very long, drawn-out process and quite a stringent process to, apply for production funding, to line up your counterparties offshore, so on and so forth. So we call on that. We look at sort of the underlying composition of the production funding as well. So New Zealand Film Commission's involved. A fulcrum's involved. There's a credible international sales agent or distributor involved. A major network offshore is involved. You put all that together, it gives you confidence that settlement risk is pretty low. And in my opinion, it's lower than your kind of normal trading importer exporter business, because you've gone through such a rigorous process to have the project greenlit and funded. And therefore, that enables us to say, hey, we don't need any form of security. We don't need an upfront deposit. And regardless of what's going on with the Kiwi over the life of your project, we're not going to ask for variation margin or a margin call. So again, sort of coming back to this point around dealing with an industry specialist, and we also touched on it well with flexibility with value dates, with forward exchange contracts if they need to change. Use an industry specialist like an Xe, because they're going to be able to provide you with a hedging facility that is not going to unnecessarily tie up your cash flow. And if you're new to all of this, or very inexperienced, work with an industry specialist who, like I said, is going to hold your hand through the process and fill any knowledge gaps that you may have. All right, Richard, any sort of final sort of comments or thoughts there?
I think you've covered it all there. I mean, I guess the really obvious question. So, given we've talked about the margins and things not being there, is there any cost directly associated with the hedging?
Yeah, good question. We might run through a couple of FAQs just to wrap up as well. There is a cost involved. So when you convert your currency, there is the wholesale interbank rate of foreign exchange, which is the rate at which the banks and large financial institutions buy and sell their currency. Now, depending on who you are and a range of factors, the volume that you're transacting, how experienced you are, that determines the size of the exchange rate markup, or the margin as we call it, that's applied to the currency transaction. So the cost to transact is embedded in the rate of exchange itself. And as a currency specialist, our remit is to provide a sharp and competitive rate relative to the banks and a lot of providers out there. So and the banks will just generally go ahead and apply a significantly larger markup or margin. And the thing about FX is that there is a lack of transparency there. It's not like it's an exchange traded market like the share market, for example's sake, where there's a centralized exchange. The price of the share that you're going to transact at. Foreign exchange is not like that. It's made up of various counterparties and market makers within the FX markets, and that they apply whatever margin they want to an FX transaction. So you could be 2, 3, 4, 5% away from the wholesale interbank rate, or you could be 0.5% or tighter with an Xe, because they're just simply going ahead and providing a lot more competitive rate through a tighter margin. So that's the cost. The cost to transact, the cost to hedge, is all built into the rate of exchange itself. So some producers, I guess further to that, some producers will ask me, okay, if I want to use Xe for my next project, what's the cost that I need to, what's the line item, what the expense item that I need to include in my production budget to transact and use XE services. Like I said, it's all built into the rate of exchange, and we're not going to charge a fee for advice or account setup fees or anything like that. So again, all in the rate of exchange there. And we work through a process sometimes with producers to benchmark and compare rates, and whether we're looking at a current project or we've looked at past projects to see what type of outcomes that they receive there. But yeah, that's cost. Another FA frequently asked question that I come across is just around the timing of, okay, I want to hedge, I want to use forward exchange contracts. When do we actually go ahead and lock everything in? We typically work to a timeline where we wait until you've closed. So your funding counterparties have executed their respective agreements. It's at that point that we can go ahead and book the forward exchange contracts. The main reason there is that on our end, as far as managing settlement risk, we're comfortable now that we're dealing with credible counterparties and they've executed their respective agreements and they're going to meet their obligations. We don't want to be in a situation where we might be 2 or 3 months out from close, or even further away from that, because things change, budgets change, the size of funding will change, counterparties pull out. So the last thing you want to do is be 6 months out from pre-production, book a series of forward exchange contracts, and the project starts to fall to pieces, and then you're obligated to settle against those forwards. So the timeline is, going back to tip 1, set our budgeted rate of exchange. We then work through the contracting process. After close or just at close, we lock in the hedge contracts. And ideally, you're doing that at an average forward rate that's more favourable to the budgeted rate of exchange that you've set earlier in the process. Trying to think of, I think we've covered most of the other frequently asked questions. Anything else on your end, Richard, that typically pops up?
No, I think you've covered it very fully, actually. Is there any questions from everyone who's been watching?
Can't see any questions. Oh, here we go. We've got some stuff in the chat here. No questions. We'll circulate this deck, so it'll be accessible somewhere on the SPADA site. But there's my details there. So if you do have any questions or a follow-up conversation to be had, then please do reach out. But I guess just in summary, we're at a very interesting inflection point with financial markets at the moment. We've got an industry that's very much springing back to life, and has been for the last 6 months or so in screen production. It's going to be a challenging year ahead, as far as a Kiwi dollar that's likely going to be moving against you over that period of time. So it's important and imperative to hedge. And to be honest, regardless of, I always put the view out there that, regardless of what the market conditions are, like I said, we're aiming for protection and certainty and peace of mind. So, the Kiwi might be heading south and pretty aggressively and moving in your favour, and it might be projected to do so over the months ahead. But we just don't know. I mean, hey, I'm a currency specialist. When it comes to forecasting currency movements, sort of 3 to 6 months and beyond, it's hard to get it right a lot of the time. So that's why it's important to hedge.
Stuart, we've got a question come in which will make you laugh, because it's what you and I have been dealing with. Is a forward currency contract the only hedging for a movie? Is there a way to play it if the currency goes in your favour? So do you want to talk about options a little bit? Yeah,
so FECs, as we've touched on, are the simplest and most common form. And I did touch on one of the yeah, the two benefits, protection and certainty, and the major drawback is that you're locked in. You're contractually obligated to deal at the forward rate. So if a scenario plays out where Kiwi dollar heads south and the spot markets are giving you more favourable rates to transact at, well, unfortunately, you've got to deal at that forward rate. There's another subset of products called options, or structured options, and I'm not going to go into too much sort of technical detail here because we'd be on the call for probably another hour and a half. But options overcome that drawback of an FEC, and options can do pretty much anything and everything, and they can have all different kinds of contingencies and outcomes. But they can still be simple and straightforward and be pretty similar to a forward exchange contract, but they will allow you to participate in a favourable exchange rate movement. So you always want 100% protection all the time, and you can achieve that through an option. But let's say, for example's sake, you lock in a protection rate through an option at 70 US cents, and you lock it in for a face value of $1 million US, and then the currency starts to peel over. Kiwi heads south against the US dollar, and in 3 months' time, it's trading at 67 US cents. Then a particular option contract or instrument will allow you to, for example, say, participate a portion of that US $1 million notional amount at the more favourable rate of 67 versus the protection rate that you're locked in at 70 US cents. So yes, there are some alternatives to forward exchange contracts that give you more flexibility. I guess the final point that I'll make there with options, they're handy products, but you've got to meet the test to be a wholesale client. And on our side, we run through a process just to ensure that they're suitable and aligned with what you're trying to achieve, and most importantly, you understand them. But yeah, good question.
Sorry. I mean, obviously, the other thing about using structured options is you do tend to, I mean, I used one, for example, recently, which, we had a range. So if the New Zealand dollar relative to the US fell inside a certain range, we would benefit from that. The downside to that is because you're going for the range, you tend to get a slightly less aggressive rate than you would for a forward hedge. So it's weighing up that balance, so the range was, the forward exchange rate might be in the middle, but your range might be more limited or whatever. So there's pros and cons about both, and it's just weighing up your risk appetite really, and whether certainty is more important than a gain.
Yeah, and it's a little bit like the three-step process that I mentioned with setting a budgeted rate of exchange, where the second point there was around, taking into account what the underlying currency is doing, how volatile it is, what's the underlying trend, those kind of factors. So you'd always take that into account when you're weighing up forward exchange contract versus structured option. And sometimes simple and straightforward is often the best. And like Richard has touched on there, your protection rate, your forward rate is always going to be more favourable than an option that allows you to participate in a favourable movement, because you're effectively you've got to give up something to get the benefit that an option delivers, and that's all kind of embedded in the underlying pricing, which again I'm not going to go into here. Yeah, the point there is, again, working with an industry specialist that says, hey, we can do this, we can hedge with FECs, we can hedge with options, they may be suitable, or no, we don't think they're a good solution for you. And just having that conversation and knowing that you've got different options or different alternatives to manage your currency risk, you're typically not going to see that kind of consultative approach with a bank.
I don't think we've got any more questions, Stuart. So I'd just like to thank you very much on behalf of SPADA for sharing your afternoon and sharing all your insights. And yeah, hopefully you've demystified for everyone foreign exchange and how producers can mitigate their risk and protect themselves. So on behalf of SPADA, thank you very much.
Thank you, Richard. It's been an absolute pleasure. And for those of you that have attended, or for those of you that might view this session at a later date, please don't hesitate to reach out. Happy to talk through anything and everything related to screen production and FX, regardless of what stage your project's at. So I look forward to hearing from you. Thank you.